Hey everyone, glad to see you all. All right, today's topic is really interesting, and honestly, I think it's not just interesting, it's super important too. We aren't going to focus on drawing levels today because that takes way too much time. For instance, at our workshops, we typically spend about 4 or 5 hours just to identify all the levels we use, naming them and explaining why one level is stronger and the other is weaker. That's our starting point, and we put a ton of time into understanding what each level is actually for. We don't have that kind of time today, so I'll just try to explain why levels matter so much and what they're used for. I'll show you maybe 5 or 10 examples on stocks and Forex and explain why they're so vital. First off, you've got to understand why you need levels in the first place. If you don't get that, you're going to have a really, really tough time. The thing is, levels are there to help you comprehend accumulation. You're looking at the accumulation between two levels: the direction, the energy, the entry point, and the room for the price to move. That is key. What are levels for? Normally, when people who prefer other strategies show up, they start asking, what the hell do we need this for? Well, I'll show you on the screen right now that levels aren't just something I made up. There's a very clear structure behind it. I'm going to show you exactly where they come from. Now watch closely. For those who don't know, this is a volume analysis trading platform called VolFix. There are plenty of other ones like this now. Almost every broker has horizontal volumes. It's a good old tool that helps explain what's going on. I don't use it to try to find whatever. I'm using it here just to show you. Now notice what happens near these levels. Volumes always start to drop near the levels where there are lots of touches, reversal points, false breakouts, or mirror-like levels. Identifying a level is easy. As you can see, this thing draws the levels automatically. No human involvement whatsoever. Typically, where strong volumes suddenly drop, that's where the strongest levels are. There's a very simple reason behind it. Nobody wants to be the first to go for a breakout. Nobody wants to waste their energy. So it all stays inside the accumulation. Every chart, every setup you see will be exactly the same. I've pulled up Forex. In this case, it's 6B, the ticker symbol for the British pound. I've looked at other assets too. See, you always have massive volumes inside the accumulation. This always means that a big player is accumulating a position within the range and then letting it leave the range. Do you see? Then the volume starts to drop, especially during the breakout. Now look at how strongly these levels hold. Take a closer look at the level we drew. Check out 1.3108. Right there, 1.3090. That's the level's bottom boundary. See? We broke out this level and started slowly consolidating below it. You can see it on the chart. This is a 5-minute chart. See, the price is positioned below the level and cannot break out. If you look through them, every single chart and setup looks the same. See, huge accumulation here because the range was massive. This is the Canadian dollar. The accumulation inside the channel is huge. This is the daily chart. Here's one boundary and here's the other. Now look closely. Volumes are at their lowest right at the boundaries of the channel. This isn't just some random drawing. I'll show you. It says right here, over 5,000 contracts in an hour, plus a limit player at $0.767. Take a closer look at this. See? The price is positioned below the level and starts consolidating. You can see in the horizontal volume system over here that we tried to break out the level once, then a second time, and now we're starting to slowly but surely consolidate below the channel's boundary. I could show you 100 charts and setups and you'd see the same thing every time. These are very strong levels. Now look inside the channel. I'll show you again and expand it so you understand that this isn't just some mystery data. There's a precise logic behind it. Volumes immediately start dropping at the channel's boundaries. There's a very strong limit player there, and here at this boundary, we also have the smallest volume. See, look at what's happening. We're moving from one boundary of the channel to the other. There are tons of setups like this. Let me show you oil. It's the exact same setup. Whether you're looking at a stock or a cluster profile, the biggest volumes are inside, and the smallest are at the channel's boundaries. This tells you that you should only trade from the boundaries of the channel. That is absolutely vital. So the first thing you have to understand is how to draw levels correctly. Levels fall into quite a few categories: trend reversal points, gap boundaries, and the upper and lower limits of pullbacks, etc. There are tons of videos online where I covered these specific assets. If you try to jump into the market and trade in the middle of a channel, you'll get stopped out. Now let me show you Forex so you understand why I haven't been recommending Forex lately. Let's look at Forex together. I'll show you why I'm not recommending it these days. Look closely. We have the channel's upper boundary over here. See? We did a false breakout against it, and we have the lower boundary. The level was tested multiple times, with the price hitting the exact same point. That's a mirror-like level right here. No matter where you enter here, you're going to get absolutely crushed. The channel is pretty wide, nearly 200 pips. If you look at the 30-minute chart, no matter where you enter, you'll get crushed. Imagine you enter on a breakout. There's a sharp upward price spike of around 13 to 14 pips in the fourth decimal place. If you entered here, you'd be stopped out like nobody's business. I don't recommend trading inside the channel because they'll just crush you. In other words, you can trade from the channel boundaries. Naturally, if you trade from the channel boundaries, you have to watch two big things: how long we've been inside the channel, how we start entering, and how we approach its boundaries, whether it's fast or slow. That's what you need to pay attention to. Look at GBP. The level was there, but it's no longer in play. The upper boundary is still holding. The lower boundary, though, has basically lost its edge too. A new channel is emerging, but the problem is that it's way too narrow. The level was there, the price moved up and down around it. The upper boundary remains, but basically the same thing happened to the lower boundary. You can move the levels though. See, a new channel formed. If you open a monthly chart, you can see these moves. I've got super old levels that go way back to 2015, the day Gerchik Co launched. I don't even touch them. Check any asset on a monthly chart. Let's look at the euro. You'll see I have levels drawn everywhere.